Who can promise how big can small, boring contributions really get over 30 years? It's a question that surprises a lot of people because the numbers can feel almost magical. But it's not magic. Today on the Capital Breakdown, we're diving into the power of compounding, the secret sauce behind turning modest, steady savings into meaningful wealth over time. By the end of this episode, you'll understand why starting early and staying consistent matters more than chasing quick wins. We'll break down the key ideas, show you what happens behind the scenes, and help you see how time and patience can transform your financial future. No hype, just clear explanations to help you feel confident about long-term investing. The problem or confusion: a lot of people think building wealth means hitting a jackpot or making a big score with a hot stock or crypto coin. But most everyday savers don't have those kinds of wins, and that's okay. The real challenge: understanding how small, regular contributions, like the money left over after paying bills or grabbing a coffee, can grow quietly but powerfully over decades. Many underestimate how much time and patience play a role, or they get discouraged when growth seems slow at first. It's like planting a seed and expecting a giant tree the next day. Growth takes time, and it's often invisible during those early years. That's where compounding comes in, and why consistent habits beat chasing flashy trends. Core concept explained. So what exactly is compounding? Imagine you have a snowball rolling down a hill. At first it's small and slow, but as it rolls, it picks up more snow, growing faster and faster. In the money world, compounding means your earnings generate earnings. Think of it like buckets holding water. You pour a little water in each month, your contributions. But also, the water itself starts adding more water over time as interest or returns build on previous gains. The key terms here are principal, that's your original money, and interest or returns, which are the extra money earned on that principal. When you leave your money invested, this cycle repeats, and your total grows at an increasing rate. It's the difference between earning on just your deposits versus earning on deposits plus earnings. Core concept explained, continued. The magic ingredient is time. The longer your snowball rolls or your buckets fill, the bigger the growth. If you start investing young and keep adding regularly, your money has decades to grow exponentially, rather than just linearly. This is why starting early, even with small amounts, is so powerful. Compounding is often called the eighth wonder of the world because of how it rewards patience and consistency. But it's important to remember that compounding works when your money stays invested and grows steadily, which means weathering ups and downs in the market without pulling out too soon. How it actually works behind the scenes: when you invest in something like a broad market index fund, a basket of many stocks representing a large segment of the economy, your money gets pooled with other investors. Fund managers or providers take care of buying and holding those assets, while brokers act as the middlemen facilitating transactions. Regulators ensure everything operates fairly and transparently. Your returns come from the companies in the fund growing their profits, paying dividends, or reinvesting earnings. Fees exist, typically as a small percentage of your investment each year, which cover management and administration costs. These fees can slightly reduce your total returns, so it's good to be aware of them. Also, when you withdraw money, capital gains taxes might apply depending on your situation, which can affect your net growth. How it actually works, continued. The cash flows in and out as you contribute monthly and as you eventually withdraw for retirement or other goals. The key is that your money stays invested long enough to benefit from compounding, rather than sitting idle in a low-interest savings account where growth is minimal. That's why many financial educators emphasize the importance of long-time horizons and avoiding emotional reactions to market fluctuations. While you don't control market ups and downs, you do control your habits, like how much you contribute and how steadily you stay invested. This combination of time, steady contributions, and disciplined investing creates the environment where compounding can really shine. Simple, concrete examples. Let's put this into perspective with two scenarios. First, imagine someone investing $200 every month into a broad market index fund with an average annual return of around 7%. Over 30 years, that steady habit can grow into a substantial amount, thanks to compounding. The money earned each year is reinvested, meaning earnings start making their own earnings. The journey isn't always smooth. There will be ups and downs, but patience is rewarded. Now, contrast that with someone buying a single speculative stock, hoping for a quick big gain. While the stock might soar or plunge unpredictably, this approach involves more risk and emotional roller coasters. Without diversification, a single stock's poor performance can erase years of progress. These examples highlight the value of steady, diversified investing over chasing quick wins. Simple, concrete examples continued. The emotional side is important too. Watching your investments grow steadily can feel slow and sometimes frustrating, especially when the market dips. But staying calm and continuing your contributions during those times usually leads to better long-term results. On the other hand, reacting impulsively, like selling after a drop or trying to time the market, can interrupt compounding, potentially locking in losses or missing rebounds. The key takeaway: compounding rewards discipline and a long view. It's less about getting rich fast and more about building wealth gradually through consistent effort and patience. Risks, traps, and common mistakes now. Let's talk about some common pitfalls. One trap is focusing too much on short-term market moves, which can lead to panic selling or chasing fads. Another is putting all your eggs in one basket, like investing heavily in a single stock or sector. This increases risk and can lead to big losses if that company or area underperforms. Leverage or borrowing money to invest adds another layer of risk that can magnify losses as well as gains, so it's generally not recommended for most investors. Remember, compounding works best when your investments grow steadily and you avoid large setbacks. Finally, not giving yourself enough time to benefit from compounding is a missed opportunity. The longer you stay invested, the more powerful compounding becomes. Risks, traps, and common mistakes continued. Volatility is a natural part of investing. Prices will go up and down, sometimes sharply. That can be uncomfortable, but it's not the same as losing money permanently. If you keep contributing regularly and reinvest dividends or interest, the overall growth trend tends to smooth out over time. Patience is essential. Another mistake is neglecting diversification. Spreading your money across different types of investments helps reduce risk. Time horizon also matters. If you need your money soon, investing aggressively may not be appropriate because you might not have time to recover from downturns. Understanding these factors helps you set realistic expectations and stay on track. How to think about this tool: compounding is a powerful tool in your financial toolkit, but it works best when placed within a solid overall plan. That means starting with a budget that ensures you can save consistently without stretching yourself too thin. It also means having an emergency fund to cover unexpected expenses, so you don't have to dip into your investments prematurely. Think of compounding as the engine that powers long-term goals like retirement or major purchases. It's about steady, incremental progress rather than overnight success. Keep your goals clear, your contributions consistent, and your mindset patient. Use compounding as a way to build confidence and control over your financial future, not as a magic bullet. How to think about this tool continued. Remember, investing isn't just about numbers. It's about aligning your money with your life goals and risk tolerance. The Capital Breakdown encourages you to keep learning, stay curious, and build habits that feel sustainable. Don't let fear or impatience drive your decisions. Instead, think of compounding as a marathon, not a sprint. Combining smart choices, time, and discipline puts you in the driver's seat. And as your knowledge grows, you can explore other investing tools and strategies that fit your unique situation. Always prioritize understanding over hype and keep your financial journey grounded in education and thoughtful planning. Recap and educational disclaimer to wrap up. Here are the 3 big ideas to remember. First, compounding is the process where your earnings generate more earnings, turning small, regular contributions into substantial growth over time. Second, time and consistency are your best allies. Starting early and staying disciplined often beats chasing quick wins or hot tips. Third, managing risk through diversification, patience, and realistic expectations is crucial to harnessing compounding's power effectively. As always, this episode is educational only. It's important to do your own research and consider consulting a qualified financial professional before making any investment decisions. Thanks for joining the Capital Breakdown today. Keep learning, stay steady, and watch your financial future unfold. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.